Okay, perfect. Today's the third in the series of our discussions. Remind everybody that we're not registered investment advisors. We are not principals in investment firms. We're not giving investment advice. If you want specific investment advice, please seek professionals and make sure that you have the right professionals at the table to advise you as we go forward. Years ago, I was raising capital for a company. It's a brand new company. I'd done it a handful of times. I knew some investors that had invested in previous successful ventures. That makes it easier when you go back for a second round of capital or for an additional company. If they know you, they are going to step to the table and work with you very quickly. In this case, we were a startup and we had no formal product built, although we had the core technology built. I raised about $10 million already and we were getting ready to close it. A friend of mine was going to Hong Kong. He is an advisor to one of the very wealthy men in China, in Hong Kong. We knew that our product, a thin film nanotechnology coating that wraps around electronics and makes them waterproof. So if any of you have a phone these days that claims to be waterproof or water resistant, that's probably our technology. But at the time, we hadn't launched it yet. So this friend of mine said, I love this technology. Can I show it to this man in China and see if he wants to invest? I said, we've already maxed out our offering, but if he wants to invest, I would consider that. So the next day, at 2:00 in the morning, my phone's ringing and I'm waking up. I get up and it's my friend. And I said, what's going on? And he said, well, I've just shown this to Mr. Lee and he wants to invest. Not a lot, but he'd like to invest a couple $1 million. Can he get in on it? And I said, yeah, I'll let him in, but here's what I want. With his influence all over China, if I take my small company into China and we invest there, there's going to be a lot of people who may want to reverse engineer or steal the IP or use it in some way. Me fighting them if it's a very small startup company is almost impossible. If he comes in as an investor, his commitment that I can use his name to say that Mr. Lee is an investor because he was known all over China. He's a man that came up from the ground up, lived in the mountains as a lower class citizen in China, continued to work hard and make good, and now suddenly he's worth $50 billion. I said, if I go in and say Mr. Lee is an investor, then the companies who I'm going to be doing business with are going to look at that and say, wow, if Mr. Lee's invested, we better not knock this off because Mr. Lee will come after us, not this company. I wanted that kind of security to protect our IP. I told him, I talked to him, and he said, I need your commitment that you will never create a problem for my good name, because that is very important to me. And I said, you have my word, I will protect your name. My relationship with my friend who walked us in the door, assured him that we were honorable and that we would protect his good name. Out of that came a $2 million investment. He wired the money 2 days later without even signing the paperwork, just because of the trusted relationship of my friend. We went throughout China and had his name on our promotional materials for our product for years, and we never saw anybody try to knock off that product. I bring this up because it's important as we go forward in our work. Investors can be incredibly valuable partners and can really help us. There are different classes of investors. Angels investors who don't typically have a lot of staff. They invest in what they know. They typically like to invest as a syndicate. They love it if there's 2 or 3 angels investing with them. And they often can move quickly on investments if it's right. There's also strategic investors. These are investment arms of corporations and companies who have been established and set up, and they typically invest for a strategic objective. Sometimes it's expanding their margins, sometimes it's diversifying the portfolio of their products, sometimes it's adding to their products. They typically like to invest in a syndicate along with other investors. Most strategics won't lead, some will, but most won't. The important thing to remember about strategics is that these investors very often will sign an LOI with you because they like your product. If they're going to invest for a strategic reason, they'll sign an LOI with you up front. And that signature, that piece of paper, that LOI is like gold when you're raising money from other professional investors. Then the third area is institutional investors. These are the venture capitalists, the private equity people, family funds. And there are all kinds of reasons why they would invest. I'm not going to go through all of these this morning. If you want more of this, either grab a screenshot here or let me know and I can send you some of the background of these investors. But some key things to remember on these is how they're organized and what they do. They're typically a large fund of capital and they invest in multiple investments. They have an established investment criteria that they follow. All of their limited partners who come in as investors in their fund are going to follow a specific investment criteria and investment approach so that they stay within the lane. That's why they can get a lot of investors into their fund, because they know what to count on. These typically are going to take a longer period of time, 3 to 6 months, to get the investment process completed with them. Never waste the time of the investors or the investment company, and never waste your time. Unless you understand how these investors are organized, what they're investing in, and what their parameters are, you are not going to be successful in getting their investment. You have to do the research on these investors. Point number one in making a pitch is to assure that you know who these investment companies are, what their parameters are. These investors talk to each other. And if we make mistakes, they're going to know it. And deals can get burned out very quick in the investment community, especially the communities you live in if you're seeking investors from those areas. And it will damage your long-term ability to, there are multiple things when you're researching an investor. There's a long list of things you should learn about the investment companies you're going to go after. Do your research. What type of investment firm is it? Angels, private equity, venture capital. What is the stage of the company when they first invest? Some investors won't invest in a very early stage company. You have to know, because if you go in and invest in your stage of company, you won't be successful. What kind of check size do they write? Some investors will only write a check size of 20, 30 million and up because it's a later stage company. You need to know that. If you're going after $1 million or a couple of million or a very early stage, $500,000, will they write the check size for that? Is that within their purview? Are they willing to lead or follow on an investment? Will they be that initial lead investor that'll gather the syndicate? And will they syndicate with other investors? Syndication is simply when there is more than one investor in a total investment premise. We already at that point had 3 investors that had invested a total cumulative amount of $10 million. Mr. Lee came in as a follow-on investment to the lead in that, and he invested an additional $2 million. So we collected $12 million from 4 different investment firms called the Total Investment Syndicate. You need to know what their investment thesis is. What is their target holding period? Do they hold investments for an indefinite period of time? If you're getting an investment from an international entity, their holding period and their long-term investment strategy typically is much longer than the US. They'll hold investments for 5, 8, 10, 15 years sometimes. Venture capitalists like a cycle where they can get into the investment and they can see and realize an exit in plus or minus 5 years. So you need to understand their holding period. What industries do they invest in? What business models? Is this a product sale? Is it a SaaS company, a software as a service company that sets up a way that people can access the software on a per need basis and use the software on a number of devices for 6 months and then go back out? They can get in and out of the software very quickly and in essence rent the software online. Some investment companies want only that kind of business model. You have to know that going in. Do they invest in target sectors of specific markets or target technologies? Some companies are more narrow in that way. Will they only operate within a geography? There's a couple of venture capital investors here in Utah that invest almost exclusively in Rocky Mountain region companies. They don't like to go outside of that. You need to know that. Do they require revenue? I want to spend just a minute on this one. Over the last few years around the pandemic, there were a lot of venture capital investors who did not fare well. Their returns were very low. A lot of companies didn't make it. Venture capital started to shift their investment strategy to invest in pre-revenue early stage companies. They started to shift towards assuring that they had some revenue. And they would set up a parameter that said, we have to have $1 million in revenue before we'll invest. Some said we have to have $3 million and profitability before we'll invest. So that precludes very early stage companies. If you're looking to invest and you're not profitable and you are pre-revenue and very early stage, and you're trying to pitch a venture capital firm that requires revenue up front, you need to know that. So that's a big one to check. Do they require profitability? Do they require revenue and profitability? And if so, how much? Because if you don't fit into that parameter, you are wasting your time and their time.
Is that something people post on their website?
What is their fund size? This is important because you need to know if they've got a fund that is, let's say it's a total of a $20 million fund, and you're asking for 15 million, they're never going to invest in you. They're not going to take that much risk with one investment. They're going to take a risk with 20 investments of $1 million each to spread the risk across multiple holdings. Do they do follow-on investments? Have they made similar investments to yours? What if they've already invested in one of your competitors? They are not going to come back and invest in you, but they will take the pitch because they want to see what you're doing that their portfolio holding is not. They'll take hints and tricks back to the company that they've already invested in. You don't want to do that. You need to know if they've already invested in a like company to you. What company support do they offer? I mentioned Mr. Lee. I could use his name all throughout China that helped me secure my intellectual property for years. That becomes a very important factor. What kind of support do they actually have to help you? Venture capital firms and PE firms sometimes will come in and say, you should invest with us, especially if they really like this and they're trying to pitch you on making sure that they get to invest in your company. They'll say, you really want us to invest because we're different from everyone else. Every firm's going to say that between you and me. Every firm's going to say, we're different. We use our backgrounds to provide support. Some do and some don't. Be aware of that and ask a lot of questions to determine what support. Do they have operating experience in your industry? This becomes really important. If they do, they can really help you as you go forward with the company. These are some of the critical things that you should pay attention to. It's not an exhaustive list. So where do you find all this? Robin, how do you know? Yes, you can look at their website. They'll have a lot of information there, but there are resources that you can use online that will help you. Many of these resources will provide background on the investors themselves. They'll show what deals they've done, who they've invested in, what fund they're in. Is it fund 1, 2, 3, 10? What their common check size is, what the last 3 investments are that they just did. Do they have an investment in a competitor of yours? You can start to look through their portfolio holdings in their funds. These resources down at the bottom, PitchBook, Crunchbase, Insights, Deal Room, Bloomberg, there's lots of others. As a small company, oftentimes these companies are going to charge a pretty healthy, if you don't have 20,000 or 40,000 to subscribe to a professional database like this, you can go to a public library and they'll have subscriptions that you can pull up on the computers there. You can go to a university library, especially in a business school. They're going to have a PitchBook. They're going to have a Crunchbase or a CV Insights or a Bloomberg terminal right there in their libraries. One thing that I've done many times, when I'm going to raise capital in a company, I'll get an intern from the university, say it's here in Utah, the University of Utah, Utah Valley University, or Utah State, or Brigham Young University. I'll bring an intern on board and say, here's your job. You need to get all of this background and data off of this database. It takes them a little while to learn how to use those online resources, how to pull the data out, but they get it. print it or send it to themselves and then bring it back. And now we've got all of the research that we need. So you can utilize that resource through those libraries. Know your audience and go research them and know that you're not wasting their time, you're not wasting your time, and that you have the kind of data that will lead to success in raising capital. Any other questions on that? Okay, let's move on. So now let's start talking about the pitch. How do you be successful at the pitch? What I'm about to tell you is the key to raising capital. There is only one factor that determines success or failure, whether you're going to get capital. Only one. Now, there's lots of factors that they're going to pay attention to, but really there's only one factor. That factor is you. You are the factor that will make or break that investment. The number one reason why investors reject an investment is you. They use a disciplined and pattern-based approach to screening startups. They see thousands of pitch decks, founders and management teams per year. And you got to recognize that because there's been a big study done. There's multiple studies, but one in particular looked at the top 10 reasons why institutional investors reject startup proposals. The most important factor is you. It's not the pitch deck. It's not your product. You may have the best product ever developed, but if you can't sell the fact that you can execute a business plan and that you can run this company and grow it, you're not going to get the money. A common thing that people say in the investment community is we invest in jockeys, not in horses. They want that management team that's going to take it home. Some red flags is if there's a lack of domain experience, no startup experience, poor communication skills, unclear roles. And if you're a solo founder that knows just about everything, but you don't have any bench strength, you don't have employees, those are all red flags. Now, maybe you're a pre-revenue and you don't have employees yet. You have to know the stage of the company you're in and be appealing to the right investors who will consider that. Just make sure that you pay attention to this. There are some trait-based missteps that founders make that are picked up on quickly. Those include arrogance, indecisiveness, inability to take feedback from the investors, lack of coachability. Those kinds of things are just death knell to raising capital. These are the other 9 top reasons why investment pitches are rejected. But I want to point out something. Look at every one of those. The lack of market opportunity, go-to-market, overvaluation. You're trying to show a much higher value to your company than can be calculated using empirical methods. No clear competition, lack of traction, misalignment with the investor's thesis. The business model doesn't scale. And timing. Maybe your timing getting into the market, the macro effects are not there. But I want to point something out. I'll give it the benefit of the doubt. Maybe lack of market, perhaps no clear competitive advantage, and perhaps timing. Maybe those are out of your control, but every other one of those top 9 are within your control. They all come back to whether you know your business, whether you've set it up right, whether you have done your market research, whether you can convince them that you are ready to go to market and that you can grow this company successfully. I would even argue that these 3 that I've said, maybe this is out of your control. If you haven't done your homework and you have a lack of market opportunity or a poor market fit, you should have known that going in. That would be a red flag for you as a management team. So pay attention to these kinds of things. These are important. But all of this comes back to the execution and the ability of the management team to bring a return on this investment. I say it again, 5 to 1 over the next closest reason of those top 9, 5 to 1, the reason it's rejected is that there's a weak or unqualified founding team. Questions about that? Comments?
I have always loved the Shark Tank, and I'm kind of surprised how well it has prepared me for this presentation. A lot of those terms that you're using and a lot of the reasons they either liked someone or didn't like someone, it really does feel kind of spot on. What's your thought on that show? Just as I say, as a little
On Shark
lighthearted
Tank?
side.
I think it's 90% Hollywood and 10% real.
Absolutely right.
When you're in front of investors and you're pitching, they're typically going to be very nice. They'll ask tough questions, but they're not going to try to show you that you don't know what you're doing or hammer you in the way the Shark Tanks do. That's all Hollywood. Maybe Mr. Wonderful does that, but I don't know if he really does or not. In reality, they're still going to ask those kinds of questions. Investors will. I've often thought, I'd like to go on that show just once so I could fire back at them. I'll never get the money, but I'd like to fire back at them. I never would go on that show because it's a waste of my time, and maybe not theirs. They do bring up some good points, and you'll learn some very good things from them. You learn some interesting principles about investing. The last thing I'd say about the show is this. You'll often notice that when they go in, they are deciding on the fly. Those investors on Shark Tank, they're deciding on the fly what kind of investment terms they would provide. They may like it. They may see some ability for it to go forward. But for instance, Mr. Wonderful oftentimes will come back and say, I will take a royalty on your investment in perpetuity. You're going to pay me 5% of your gross revenues in perpetuity, and I'll give you X amount of money. Well, what he's trying to do there is he's setting up his return based on your cash flow. He's also setting up the founder and the CEO who's presenting to him. He's setting up that CEO. If he or she do not perform, if they don't execute on the investment, he comes in as an investor and says, my only return is this revenue and you're not producing it. You're out. And he'll get the board of directors together and force you to be removed and put somebody else in that can produce the revenue to give him the return.
Oh.
So those kinds of things happen in investing. One where I broke all my own rules when I went into an investment meeting in New York City. The head of the venture capital firm walked me into a boardroom, and he had to have had 15 people around the table to see this investment. When I saw that, I knew something was up because I suspected that he was going to grandstand. He had no intention of investing in our company. He wanted to prove something to his young associates. So I gave him the pitch, and afterwards, he didn't even ask any questions. He just said, we would never invest in your company. I said, got it. Give me some feedback. Why? And he said, because you're from Utah. And Utahns get together with their buddies, and they don't hire the right employees. They hire somebody who's in their community, golf club or church congregation, and they don't hire people from the industry. And I thought, wow. I tried to talk to him about it. He said, just doesn't matter. I'm never going to invest in your company. And I said, thank you for your quick feedback. May I ask a question? Where did you go to college? Harvard. I have a Harvard MBA. And I started going around the room, Harvard. And after about the first 5 or 6, I said, so we have a mutual feeling about each other here. I would never take an investment from your company. And he said, what are you talking about? We're all from Harvard. And I said, that's the point. All you did was hired your buddies and people out of Harvard Business School, and you don't have any perspective. You don't have any diversity of educational background. There's no way I would ever take your money. I broke all my own rules. Don't ever, ever, ever do that. I was young, I was stupid, and I never should have done that.
Well, I got a question and a comment. A comment first on the Shark Tank thing, Eileen. I did a lot of research on the show a couple years ago, and Paul's absolutely right. 90% Hollywood. Those are heavily edited things you see on TV. They generally take 4 to 5 hours per person to go through things. In terms of the pitch thing, I totally have seen a lot of bad pitch decks and bad pitchers. My biggest question to you, Paul, and this probably goes to what we're going to do after this series is over in terms of having people submit their decks and give them direct feedback. A lot of ideas are born from technicians, like engineers, and they don't communicate as effectively as someone who's more charismatic. How do you bring that up to somebody that, hey, your idea is good, but you suck? Or how do you help somebody get a pitch person or make them better? I've seen a lot of decks recently, and I'm throwing up in my mouth a little bit.
Good question, Doug. First thing I'd say is this. If you are the founder, the inventor, and the CEO of the company, you can't get away without being in on that pitch. You can take somebody with you who has good pitch skills, but they're still going to keep turning and talking to you. So you're going to have to be very confident and know the business. My preference is to take founders and say, let's work through this. Let's get the pitch deck down. Now we're going to go through 10 or 15 or 20 rehearsal sessions for you to pitch. You don't have to be dynamic. You don't have to be entertaining. You have to be competent and confident. And that's an important thing. So you're going to have to practice, practice, practice. And we all know practice makes what? Not perfect. Practice makes permanent. So if you're practicing in the wrong way and you're practicing send the wrong signal, you are making permanent a pitch that's never going to work. So make sure that you get feedback, that you understand. So as you practice, it makes permanent an excellent pitch, teaching the right things. Now, if you need to bring somebody else in and you want somebody to help you through that pitch, don't bring in a team. Bring in one other person. Yeah. Maybe that's your head of marketing. Maybe that's a board member. Maybe that's an advisor to the company. But I will tell you, be really careful with bringing in advisors on a pitch deck, because investors oftentimes look at that and say they're trying to get somebody with experience who's an advisor to make up for their shortfalls. You have to be really careful with that. So, great. Doug, does that answer your question?
Spot on. Okay, great. Thank you very much. Takita's got a question.
Hi, Paul. I'm not sure if I missed this, but could you expound on the red flag of solo founders with no bench strength?
Yeah. What I just mean by that is that you may have a founder who is really good, really technical, has a lot of great strength, but they don't have any employees around them. You can't put up 2 or 3 other people on the slide about a management team that says they have the same skills and the same strength that the founder does. So it's one strong founder and a bunch of interns.
Ah, got you.
Okay. So that you don't have anybody on the bench that can support you. Your bench strength is very weak.
Got it. Thank you.
Anything else? Let's move on. There are solutions to these problems. I've been talking about them. A solution to weaken an unqualified team is to have concise bios ready, have a slide that highlights strong backgrounds in your team, emphasize startup experience, exits by the team, domain knowledge, key prior wins. If you don't have any of that on your team, you need to hire somebody. Be very careful about just getting somebody who's a good advisor and taking them in and allowing them to make your pitch, because the investors are not going to like that. They're going to look at it and say, this person isn't even around all the time. They meet with them once a month and get advice, but they're not even around to execute. You need to show the team chemistry and speak about your bench strengths, speak about your employees and those around you and the strengths that they have. If you have another person or a co-founder, you can turn over to them if you've practiced it. Don't make it awkward. But if you practice it, you can turn the time over to them and they can jump in. It shows you have good chemistry and you finish each other's sentences and you work together well. And most of all, be coachable. Investors hate it when they get an arrogant founder that shuts down the investors to say, no, you don't understand. We know what we're doing. Investors see a lot of pitches. I'm the first to say, I don't think investors have as much direct domain experience as we often do as founders. I'll never say that out loud to an investment community because we don't want to offend them, but you still take advice from them and you'll get good suggestions from them. Your second reason people reject pitches is also a very big one. It's the lack of market opportunity or poor market fit. Make sure that you have a clear market size chart. Have targeted obtainable market as part of that. Have LOIs that your TOM prospects, TOM prospects have signed, ready to go. Focus on a real pain point, not a nice to have. Use good language like our first market partner jumped on board because. Use real examples of people that you've already secured as customers or whatever it might be. And then founders often mistake technical novelty for market demand. You better make sure you go in and pitch that you don't just have a technical novelty that doesn't have much of a market behind it. And then prove your market. Don't just state it. This is what the investors are looking for. They're looking for you to show them that you can execute very, very well. The market chart I'm talking about is something like this. So total addressable market, this is the mass universe of all of the people, all of the companies that you could sell to in the world. You put into a big market and you do the research, you know what that market size is. The serviceable available market is a subsector of the TAM. This is a market available to you at this stage in your company based on geography and operational limitations. So it's a smaller portion of the market. Then you have TAM and SAM, and then SOM is your serviceable attainable market. That means it is a subsector of the SAM, and it's showing the investor that you've done your homework to know exactly which portion of that SAM could be captured by you in the near term. Now, TOM is one that you're not going to see in the market. I use TOM. I created that. TOM is a very important piece of this market. If you have the targeted obtainable market, these are targeted companies that you can go into to be early market partners, early customers, early adopters. These are go-to-market partners. If you add that targeted obtainable market, the TOM, into your market chart, you will impress investors because you're saying to them, this is who we're going after right this minute. The SOM may be much bigger, but the TOM is a smaller section. The smallest section of the market are your very first partners or customers. If you hammer on that, it will be impressive to the investors because they're going to look at it and say, they've really dissected their market. They know what they're doing. So if you're an early stage company, be sure to include that targeted obtainable market. You can grab these charts if you want. I'll send it to you and you can use this chart and just put in the numbers you want. If you go and put market size chart into Google and then go to images, they'll have hundreds of these kinds of charts.
Paul, do you just make these numbers up? How do you make these numbers up?
You can make them up and go into an investment pitch. But if you do that, will you promise to invite me so I can just sit and watch what happens? They'll tear them apart. One of the very first things a professional investment firm is going to do, if they like your pitch and they say, we're going to start to do some due diligence on this, we're going to tear into your pitch. They're going to hand this market information to an early associate, to an intern, and say, go validate these numbers. You go figure out what we think the real numbers are. If those numbers actually are the same or close to what you have, they gained a tremendous amount of confidence in your ability to operate and understand your market. So you put in market size. There are reports all over the internet. My last company was a cybersecurity company. I could go in and say, what is the total global market for cybersecurity software? It'll pull up all kinds of charts that companies research and do. There are companies all over the planet that do market research charts. They figure out how big the market is, how much revenue is being generated. But then I'd have to go back because our cybersecurity company didn't go to the entire market. We went to a subsector of the market. In particular, our cybersecurity provided encryption and security on the smallest of computing devices. So this was like a Nest thermostat or a software program on an automobile that had a chip in it. We would secure all of those kinds of programs. So now we had to start to break that down. Sometimes you'll run into things where you'll say, what is the market for the total market for Internet of Things, is what these small devices are called, Internet of Things devices for encryption and security. When we first started doing that, I pointed out to some research houses, I called them. I said, you've never assessed this market for IoT security. They said, that's right. What are you talking about? And within a couple of months, they published a study on IoT security market size because they could see there would be a big market for that. So you can nudge them in the right way, but there are all kinds of market research data out there that you can find. When you get down to the TOM information, you will come up with that. And it's not really a guess. You're going to go out and look at your target customers, then go online and say, what's the revenue of XYZ company, until you can make a quote unquote guess. We're going to sell to them. They have X number of devices on the market. Our software will cover those devices. I'll take 25% of those devices and assume I can get them to put it on 25%, and then calculate that according to your per device price, and you'll come up with those numbers. Very common for an accounting firm, for a CFO, for an accountant to put these numbers together if they can help you. Okay, let me move on. The first one is the big deck. Doesn't matter how many slides. In my cybersecurity firm, our big pitch deck had 275 slides because it dissected the market, it dissected our business, it dissected our technology, it dissected our management team, it dissected every piece of the business. In essence, that large pitch deck was our business plan, a very detailed, very organized business plan. From that larger pitch deck, you can start to break that down into what I call the main deck. This is going to be 20 to 30 slides maximum. It's going to be an extended summary of your big deck. Then you have the short deck. This is very small. It can be anywhere from 5 to 15, but really 6 to 12 slides. This is the deck you're going to send to most professional investors to have them begin to look at your company. After you've caught their interest, send them the short deck so that they've got something. Now remember, these investors see thousands of investment presentations every single year. They're seeing hundreds every week. And you have to have a short deck because they're not going to pay attention to a 275 slide deck. But before they invest and they're doing deep due diligence, they will go through every slide on that 275 deck, and it increases their opinion of you as an operator to be able to execute. They know you have a plan, they know you know what you're doing, and it gives them a lot of confidence in you as a manager and the management team. That's why I advocate having these different versions of the deck. Finally, you get a 1 to 2 page teaser that is for mass distribution. This one you can give to accountants, attorneys, business consultants who may know investors. You can say, here's my 2-page summary of my company. I'm going to be looking for investors that invest in X, and you can ask them for referrals. If you meet somebody on an elevator and they say, I really like that, can you send me a summary? Just send them the 2-pager. But that 2-pager better be powerful, and it better be your pitch deck, the pitch deck that really makes a difference, your initial elevator pitch. One note on this, lots of people will say, I'm never going to send anything out without having a signed NDA. You won't get a lot of interest by doing that because people don't want to sign an NDA until they're quite interested. Investment firms will never sign an NDA. I've had different experience from that. Only one time would an investment firm that I wanted to work with not sign an NDA. They flat out refused, and I thanked them for their time, and I went on and raised capital elsewhere. I've talked with hundreds, maybe even thousands of investment firms. Eventually, they will sign an NDA. Some will sign it immediately. Some takes a little while until they look at your firm. You should be able to send the teaser and the short deck as non-NDA versions of your pitch so that you can distribute those. Okay, what should your pitch deck have in it? A successful market story. I'm not talking about the market size. I'm talking about a story. I started today by telling you about Li Ka-shing in Hong Kong and how we raised money for him and how we used him. From that story, as you're thinking about a lot of what I'm telling you here, you think, oh, I see why he did that, or I see that he got his interest by doing such. If you start with a story that is very short, I'm talking about a 2-minute story that shows how you presented your product, why a customer used it, and why they adopted it, or a story about another investor who immediately invested because they saw the power of your product, that story catches their interest. It catches, you immediately get them to pay attention. It gets them thinking. So I'm talking about telling a story. The second thing is, this will be in the pitch deck with slides. You're going to outline the market problem. Why is there a need for our solution? Outline how the company fixes it, the features, functions, and benefits of your solution, and the actual competitive advantages. Is it cost? Is it delivery? Is it supply chain? What is it? You should put in your pitch deck your business model. Do you sell this $10 per widget, or in a SaaS model as a per unit, per month charge? What is the market size? What is your go-to-market plan? Are you going to sell this directly or use channel sales? You should have your launch metrics. You should show them. Now, I'm going to start to get into some stuff here that will make sure that the investors see you as the great operator that you are and the ability to execute on your business plan. This is important. If you have your launch metrics somewhere in your pitch deck where you can literally say to the investor, these metrics that I'm showing you here, these are what we use internally to manage our company. We review these every week. They will start to say, this isn't just a pitch deck. This is showing exactly how they operate their company. Your management team should be a slide on them. Your current financials and projections. I'm not talking about a full P&L statement. I'm talking about a summary statement and what the projections are about how that's going to move forward. And then you should have something that says, here's the investment offer. We are seeking to raise $2 million on a valuation of $10 million. We're going to hold 20% of our company post-investment. You should have a statement on the cap table. We talked about this last week, what a cap table is. You should be able to say, we have 9 current investors who own X% of the company. Our management team, me and the other insiders own X% of the company. Because what I'm giving you here is questions that they're going to ask very quickly anyway. If you answer those, even on the short summary deck, they're going to understand what you're offering. Those are elements of an investment pitch that I have found really effective. These are elements in a survey that was done. You can see the first column there, 500 startups. The second one was a very famed investor. The third one was Sequoia Capital, a famed venture capital company, Nextview Ventures. Then they went to Crowdfunder, a different kind of investment firm. And then they went to the Airbnb pitch deck, which is widely seen as one of the most successful pitch decks ever used. And they said, what were in those? What makes up the good investment pitch? This is just something that when Doug distributes these slides, you can see. What you can see is an executive summary. When you're actually giving a pitch, people want you to get into more information. The problem, the solution, market valuation, everybody wanted it. How do you make money? They're going to want to know. People didn't want you to focus on something just that's magic, but that's probably because you're going to show them that in your solution. Your founding team was important to them, and fundraising. That means, what do you want from us? This has always worked for me. But you'll have to come up with what you think really works for you to make a very dynamic pitch. In your pitch deck, I think it's advisable to use the rule of 5s. That means in your PowerPoint, no more than 5 words per slide, no more than 5 lines per page, and no more than 5 consecutive text slides without a chart, a graph, a picture, something that shows, because you've got to break up their focus. If you don't have something that causes their left brain to work as much as their right brain, you're leaving something on the table. This is the golden rule to get the gold. You should have your elevator pitch, your very strong pitch right up front that you refer back to over. So strong, so powerful that when you leave that investor's office or you leave that pitch on Zoom, that investor is going to be able to walk out, get on an elevator with somebody, or walk to the office next door to them, or whatever it might be, and say, let me tell you what I just heard, and repeat your pitch. It's got to be that simple and that easy. Yeah, Doug.
Yeah, boy, this is such gold. I'm just learning so much. I'd like, if you have it now, great. If you don't, it's okay. But I'd love an example of that short. It's always harder to do a short version. Do you have anything you remember from your days?
Sure, there's lots of them. I was CEO of a nanotechnology company. Our nanotechnology coating made electronics waterproof. I could go in all day long and say, our technology makes your smartphone waterproof. And I walked into every single pitch with a pitcher of water.
Yeah.
I would take the back off of my phone so the electronics were exposed. I'd drop that in the water and it stayed there during the whole pitch. That was the easiest product I've ever had to pitch and get money for. So that's one example of what we used. But the first couple of pitches I didn't do that. I found that once I put a phone in a pitcher of water,
yep,
it was over. I would meet at restaurants, Doug, and I would ask the waitress to bring me a pitcher of water. And I would drop the phone in there and start talking. People would get up from other tables and come over and say, what the heck are you doing? It was really awesome. It was a great pitch.
Thank you.
Okay, so that is the golden rule. Make sure your pitch is concise, short, repeatable, without notes, memorable. That's very, very important. Even if you are not the most professional presenter and your presentation is dull, if you do that, that gets you a long way. Whoops, wrong way. So, how do you appear and become a very strong, qualified founder and CEO? Here are some things that will really show your competence as a CEO and a founder. Show real-time reporting metrics on a dashboard and tell the investors all the way along. The pitch deck is a living internal document shaped by real performance and frontline output. Make sure the investors know that. It's not just a pitch to get money. This is how you run your company. The fundraising pitch is a filtered snapshot and not a fabricated PPT to impress. Don't just raise capital from the deck, run the company from that deck. Then it becomes believable. And you highlight that and you tell people that constantly. Here's the capital acquisition process. And it is a process. Number one, you develop a go-to-market plan to acquire capital. You research the investor in your space. You prepare the contact lists. You network on LinkedIn to find who knows that investor that will make a warm introduction for you. And you prepare the cold contacts and what you'll say when necessary. Two, you go to market quickly and intensely because momentum is your friend. There is a literal and palpable thing that happens in raising capital, and it's called deal fatigue. Investors talk to each other. If you've been out there for 9 months trying to raise capital and nobody has bought your pitch, investors talk and they'll know. They just look at it and say, somebody knows something that I don't. Everybody's passing on this. We're not going to invest. Momentum is your friend. When you go to raise capital, don't say, I'm going to take the next year and a half to raise capital. Say, I've got a 6-month window and I better have a lot of people interested in the next 3 months and go after that with zest. Shop for a lead investor first. That means shop for somebody who will say, you're raising $10 million. I'll give you $2 million of that and I'll set the terms of the deal that everybody else will follow. Once you have that lead investor, it is 90% easier to get the next 8 million of your syndicated investment. 90% easier once you've got a lead investor. Why? Because somebody will look at it and say that lead investor has already done the due diligence. They've already done all of the work to vet this opportunity, and they put some trust in that. The followers will call that lead investor and say, what do you think? Why are you making this investment? What due diligence have you done? It just makes it infinitely easier. Get a lead investor. And then use your own attorney to negotiate the final documentation. That's very important. so that you've got somebody representing your interests. Any questions about the capital acquisition process? It is its own business plan. The more effectively you execute on the capital acquisition process, the more investors will know you know how to operate. Here's some don'ts. Don't assume you know more than the capital finance person, and never cite the total addressable market as your market. You selling an automotive air freshener and taking the total amount of money made in selling cars around the world and saying that's my total addressable market. You have to know your market. Investors will cancel or reject a plan for not understanding your market more than any other thing. Never go to an investor after you're already out of money and now trying to raise money. They don't like it when you're going to them saying, yeah, we ran out of money. We didn't realize that we were going to be out of money. So we got to raise some money quick so we don't go under. That's the biggest red flag. People will just say, good luck to you. I hope you find the money, because they're not going to throw good money after bad. It may mean that you are so far gone that they're never going to get it. The second thing that will happen is some people might see it as an opportunity, and they'll say, well, I like your product. I'll give you some money, but for that money, I get 60% of your company, or some other terms that are just wholly not doable for you. They'll be egregious terms. If you're that far out of sync with your business that you're going to go try to raise money after you're out, then you do have an operating problem. Your execution strength is not good. You got to step back and figure out how to do this differently. Never tell a professional investor that your company is worth 100 million right now. You've got a company, a good product, you don't have any revenue yet, and your minimum viable product is not ready yet, but boy, we think this is worth 100 million bucks. The investor's just going to say, this is not a realistic operator. They don't know what they're doing, and we're going to pass. They don't know how to execute.
Hey, Paul, Rose has a question about early stage rounds with lead investors.
Please, Rose.
Go ahead, Rose.
Hi, Paul. There was a couple slides back when you mentioned always go to the lead investor candidates first. So I was wondering for early stage rounds, maybe pre-seed rounds when there is no lead investor, I guess want to get your thoughts on our approach. Is it still have a list of angels and family offices and just kind of go based on the profile?
I would still go to one of those investors and ask them to be the lead. Oftentimes, even in a very early pre-seed round, you might have a bunch of angel investors who are looking at it, but they haven't pulled the trigger. If you can go to one of those who's very strong on it and say, will you be the lead investor who says, I'm in, and set the terms? We'll develop a term sheet around what your terms are, and we'll go to these other 4 investors and say, we have a lead, here's the terms, will you join us? I can't tell you how powerful that is. And they'll say, yeah, if he's in and he set the terms, I know what it is, let's do it. So I would still seek that to help you close. Now, if you've already got 4 that are saying, we'll all invest, and they'll all invest at the same time, then close them immediately. Negotiate the terms, give the terms to everybody. But oftentimes it just works better to have a lead investor.
And they don't need to be in a syndicate, even if they're like 4 different angels coming on the same term sheet.
Well, that would be the syndicate, would be the definition of the syndicate, those 4 investors. The other thing that is very important about this is sometimes a group of investors say, we'd really like somebody to be on your board if we're going to invest this amount of money. Well, you don't want all 4 investors to be on your board. You want 1 out of that group. If you've got a lead investor, you can say the lead investor will be on the board. The rest of the syndicate that lead investor will be their representative on the board.
A percentage of feed, and then they have a certain number of investment they have to do over a year, things like that. But you're saying that when we have the term sheet with multiple angels coming in, that's also another type of syndicate, but it's not going through an organization on the cap table. In the first case, it's just one line, right? Whoever the group is investing versus now you still have 4. Do you still have 4 lines on the cap table if they do this?
Yeah, you typically would have all 4 on the cap table because they're going to want to be shown on the cap table. unless they've all banded together and formed a separate LLC, put all
Right.
their money in an LLC and invested as a single investor.
I see. And then both consider syndicates.
Yes.
I see. Thank you.
If you're getting several investors together and they're going to invest in tranches, they say, we will invest here. They're likely going to have milestones that you have to meet for them to invest that next tranche. If not, if they say, no, I'll just put 25% now, 25% in 6 months, 25% in 12 months, that's a good way to do it. But let me just tell you, people's investment outlook, their investment availability changes over time. And sometimes they won't be able to do it. And it leaves you in a really difficult position down the road. Try to get all of the money up front whenever you can. Try to get all the money.
Thank you.
Okay, number 5, never over promote and underperform. If you do that, you will show that you're not a good manager. You don't have good execution capabilities. Sometimes the tendency is for all of us to say, I'm going to sign a new account next week. That new account will be on board and we'll be ready to go. Most wise investors will say, let me continue to look at this. Let's talk at the end of next week and I may be ready to go. One of the first questions they're going to ask you is, did you sign your customer? If you say, yes, I did, and here are the terms and we're now ready to go, that's good. If you say, no, something came up, we're now not going to sign till next week, they're going to say, let's check next week. What you're showing them is your inability to execute, or you're over promoting and not performing up to what you're saying. Those kinds of things are really difficult to overcome. Never blindly refer someone to an investor without vetting them. Once you've got investors, you may find out their investment fund is really good. You may know somebody who's an early angel investor of yours. You think they may want to invest in their venture fund, so you refer it to them. Those are good things. Investors love that. They know you're a partner helping to build their business while they're building yours. But if you just meet somebody at a social event and they say, yeah, I'm looking to invest, say, oh, great, I'll introduce you to my venture investor. Sometimes you need to vet those, because if you're sending people who couldn't write a big enough check or couldn't invest in them, you're wasting the time of the investor, and that's not good. So make sure you do some vetting if you do that. Here are the do's. Practice your pitch. And I mean practice. Practice makes permanent. Get a good pitch, improve it, and practice it constantly. I can't stress this enough. The more practice you have, the better your pitch is going to go. Always build relationships with your potential investors. Don't just go out and say, here's our pitch. When can I expect your check? Build a relationship with them. Ask questions. Get to know if they've got a son or a daughter giving a concert next week or playing in a football game. Get to know all of those things. The stronger the relationship you can build, the better it is for you. Be on time. If you're going to start a meeting at 10, be there at 9:45. Be prompt, because they're going to be watching you. Do they show up when they say they're going to show up? Sometimes things happen, traffic, car issues. If that happens, don't just show up late. Send a text, send a note, call, and say, this has happened. Just have complete integrity. Always ask for feedback. Even if somebody rejects your pitch, ask for feedback. Why? Because you're going to take clues from that and ask them to be candid and forthright and tell you why they rejected your pitch. If they give you advice, write it down, thank them for it, and learn from it. Always ask for next steps. Somebody says, well, this is interesting. I'd like to study your pitch deck a little bit more. Great. When should I contact you? Do you want me to contact you by email or by phone? Make sure that you follow up. Always ask for referrals. Sometimes you're going to go into an investor who fits for them, but maybe they're at the end of an investment fund and they don't really have any more capital to invest in your deal. And they say, we're not going to be able to invest right now. I'd like to stay in touch over time. Thank them for that and say, do you know another investment firm that this would fit with that we should be talking to? And if they say, yeah, I do know somebody who invests in like this, here's their names, here's their firm, then ask them, would you send a note and introduce me? Because then it's a warm introduction from another investor. I would always ask for those referrals. Sometimes when you ask for feedback, they'll say, I really don't like this, and it didn't work because of this factor, this factor, this factor, and this factor. You may not want to ask for referrals on that one. Take their advice, go elsewhere, or leave there and improve, because you don't want them making referrals to somebody after they've had a negative impression. Always send a thank you note. That can be an email, it can be a text, it can be whatever, but thank them. And if there are follow-up steps, put those follow-up steps in the thank you note. Say, I will be contacting you on this date. I will be following up. I will be sending you this. Always network in your local community. Accountants, attorneys, other angels, startup companies, organized groups, even if it's just community groups. Join them, participate with them, get to know them, ask for referrals from those groups. Always refer potential investors to your limited partners if you meet them. They really like that. It shows that you have an interest in their business as much as they have an interest in yours. Present with competence, confidence, clarity, and brevity. That can only come through practicing your pitch. It's just really important that you do that. You need to sell by being you. Don't try to be something you're not. If you do that, you'll have success. Let's take the slides out now, and I'll just answer questions. That's the end of what I have for you.
Thank you, Paul. Go ahead. Questions, people. Who here is actively working on, or even the thought of raising capital? Raise your hand if you're actually thinking about doing it. All you guys, most of you guys. Okay, great. I don't know about Mike and Takita because I don't see them here, but if you did, give me a thumbs up. I'm just curious if that's true. I wasn't thinking about it until I met Paul. Now I'm thinking about it. So. All right, questions. Go ahead. We got a few minutes here.
Any stories? Any comments? Any experiences?
Oh my gosh.
I have a story.
Let's hear a story from Rose. Go ahead.
Yeah, no, this is, I think someone earlier in the presentation asked about making up numbers for the market size slide.
Yeah.
I was presenting to a potential investor, and it was funny because I have my numbers substantiated. My startup is, we have a B2B software platform that helps medical device company get through FDA 3 times faster. So one of the questions they asked was, how many application did like FDA approve like last year? So I have a number, I gave him a number, and then on that immediately, he just used ChatGPT to see if my number was correct. So in that case, well, because, ChatGPT has, sometimes they hallucinate and make up numbers. So in that case, they gave the same number. So he was like, oh, okay, good. So he validate on the spot with ChatGPT.
Wow.
But if ChatGPT gave a different number, then I would have to walk through how I come up with the number. Then, they're going to ask, don't make up your numbers because they're going to check.
Yeah.
If they did ChatGPT right there in front of you and they came up with something different, I would challenge it immediately. I would say, I think in this case, natural intelligence is going to beat artificial intelligence. Here's how I got my number, and prove to them how you got your number.
I have one story. I was actually part of Oren Klaff's cohort for a while, Paul, from Pitch Anything, and his next book, Flip the Script, is even better. And one of the guys was selling really large enterprise software for hospitals. It was 6-figure, 7-figure software. It's not an easy sale to make, but as sales guys do, they're trying to pitch what they're doing. One time somebody asked him, why are you doing this? Everything changed. Talked about his child and the challenge at the hospital. This software was really designed to help save his kid's life. And the person said, I'm in. By telling that personal story, that passion, purpose of why he's doing this, 2 minutes, like you mentioned earlier, his sales just went to the roof after that. So this is my sweet spot. I'm not the technical guy, but I know stories move people to action. When it comes time to get your deck and your pitches ready, Paul's going to be giving us a lot of feedback on what we're doing right, what we're doing wrong. And I'm going to be talking about stories and why, when, how, and where to tell them, because they can be short and they should be, but they got to have meaning behind them. So that's my 2 cents.
That's a really great comment. And
Yeah.
like I said earlier, the number one item on the list of what you should have in your pitch deck isn't even in your deck. It's the story right up front.
Yeah.
why, and that story and showing what a customer did or whatever it might be may include some personal element from you that shows why you have a passion about this.
I was on a competition, pitch competition. I was a judge for a competition, like 50 people or 100 people, whatever it was. I could tell you as soon as they were all done, I knew which one was going to win. It was this gal that had the best story. It was fitness software, no big deal, but her story, oh my gosh, she won the competition because of the story.
Pulled you right in. Yep.
All right. Anybody else? Go ahead, Donnie. You had the question earlier, Donnie. Go ahead.
Yeah, this is Doug. I just happened to check out the article that you put in Circle, and good Lord, it was awesome. But it pairs up very well with what Paul is saying, challenging your assumptions. And like, don't go into an investor meeting without knowing what kind of investments they pair with. The article on the MVT, that's excellent. And I would love to take a session to work those through. I'm mapping it out right now myself. And I don't know if Paul had a chance to check that out or not, but that is a process for, and Doug, you may be able to explain it better, but it's a quick process on how to test out your assumptions. Also figure out what assumptions are you bringing in, because the investors are probably going to tire kick those exact things. I mean, it's like Murphy's Law. It's going to go right to where that, oh yeah, well, we're working through that or whatever. I wanted to open it up quickly for a comment or two on that subject.
It was a great article. When I'm done here in about 10 minutes, I'm working with my referral from Paul on Yukta, who's building our Circle community for us. I'll make sure everybody gets that. I'll email to everybody as well, Donnie. I think it was a real good article.
Good comments.
All right.
Whatever you do, just make sure you have fun doing this. Raising money, if you're having fun, that communicates through to investors as well. They want somebody who can execute and can have fun. Rose?
I have a question. To track all your investors and your pipelines, are you personally using any tools or just using Excel to track all your past, when you look up the list of all the investors in your process?
Some time ago, I created a macro in Excel. I keep track of the name of the firm, contact information, things that I learned from the research that are important for me to know. I put in the date of first contact, the date of first discussion, the date of the pitch, and I track all of that. And then I summarize it on the macro down at the bottom so I can see how many people I have that are in, how many have said no. And then I put in feedback in a notes section on the macro. Usually when I'm going through a process like this for a company, I have my assistant or an intern track all of this for me, and they'll follow up on every single deliverable that we have to do, because we're all busy as founders. We're all busy as CEOs. We can't just stop everything else to raise money. So for me, I have to have somebody there that's going to come to me a few days before and say, on Thursday, we have this follow-up and this follow-up call. We got to be in on it. It's on your calendar. Then we go into prep sessions to make sure that we're all ready to go. I do it on Excel. I just build a little macro to put in all of the data and show what progress we've made. At the end, after we've raised the capital, I do a post-mortem follow-up with the entire team. How many contacts, how many pitches, how many follow-ups. They create a map for future rounds of capital. And that helps us dial it in for the next rounds. It helps me for other companies and companies where I sit on boards. I can speak with more experience and authority saying, this is going to take you 9 months from start to finish, and here's how it's going to work.
Speaking of this, you've mentioned interns a few times, so I'm going to let the cat out of the bag right now. We are launching this fall Visionaries Youth, and I'm going to be hosting a nationwide competition for 13 and 19-year-olds with cool ideas, and we're going to give them part of this program to help them formulate their pitches for their teen Shark Tank, but with nice investors. The concept is to help them with their bright new ideas, but also for those who don't have ideas, they're going to be offered to be interns for us. So if you want to mentor a teenager or you're looking for an intern, this pool is going to be designed and built for us over the next 6 months, and I'll be talking more about that in September. Interns are coming.
Yeah, I just want to chime in on that, Doug.
Thanks, Jen.
That component has come up so many times already that Mohan and I would talk about it. What really got us into considering that, or Doug considering to add that component, is that we were in New York, in Brooklyn. My stepdaughter mentioned how many of these kids in high school and college asking, "Oh, I want to learn about business, but I don't know, I don't really know where to get the right information." They do consume TikTok, Instagram Reels, but they're asking, who do you talk to? You don't have access to these entrepreneurs. The world is saturated with content. A lot of kids want to be influencers because that sounds like easy money. But there are outliers, kids who wanted to be in business but don't have access to people like you. So that's how it came to be for Doug.
So, there you go. Thanks, Jen.
Oh, hello,
Real quick,
Rose.
I have a
Brooklyn.
quick question too. When everybody's talking about interns, I'm a college professor also, my students are being
Yeah.
placed as interns. So here's my question for the group. Are you paying your interns or no? Because I know a lot of the interns I place get paid, but I know equally as many do not.
I've done both ways in my previous businesses. I had unpaid for the first 6 months and then went paid after that. So I did a hybrid myself. Anybody else?
I typically pay the interns something. Occasionally, I'll have an intern who doesn't have much time. They're very busy with their schoolwork and can dedicate maybe an hour 3 times a week, those kinds of things. I typically don't pay them, but I make sure they understand. We'll give them a rich experience understanding how the company works and work on meaningful projects. But most of the time, I pay mine.
Keith's got a question.
Paul, have you ever raised money for a nonprofit?
I sat on a lot of nonprofits and charitable organizations. And yeah, I have, not anywhere to the degree that I have for profit businesses. Keith, have you done that?
I have in mind to do something set up as a nonprofit. I've always wondered, other than, a warm fuzzy or goodwill or whatever, or exposure, they could co-brand it or something. What is an investor's justification for investing in a nonprofit?
I interviewed a consultant in this space, Keith, and he shed some interesting light. This rich family had been donating money to this music academy for years, and things were tight one day. He's like, I'm not sure if I can do it this year. And instead of appealing to his altruism and sort of, hey, it's good for the kids, he brought him to a concert. And like Paul's thing about the phone in the glass, glass of water, experiences, and they have an experiential immersion into what he was doing. They wrote a check the next day. Getting into the psychology of donations is very interesting. Strangely, a lot of people will tell you that, donating to charities is actually a selfish thing because it makes you feel good. So
yeah, it's a fundamental to charities. Now, if it's a nonprofit, but it's an operating nonprofit that provides something, that might be a little bit different. Most of the time, the fundamental pitch is different. You're not appealing to the return on investment. Those who are really successful at doing it don't just call up somebody and say, hey, can you donate $15 to my charity this week? If they want substantial contributions, it's even more important to know your investor. You've got to know what triggers they have, why you should go to them, why this would appeal to them. You've got to do a lot of homework on them. That's where LinkedIn referrals and warm leads would come in handy and very important.
Right. Any last questions? We've gone way over, but totally worth it. Anybody else have anything else want to add, ask?
Yeah, when you were talking about the waterproof coatings and dumping your phone in a bucket of water, it reminded me of I don't know if it was PPG or one of the glass companies invented tempered glass to hit all their salesmen out to sell it. This one guy was miles above everybody else in terms of what he sold of this tempered glass. And they had this big award ceremony and they said, how did you do it? He said, I took a hammer along with me and I hit the piece of glass. People were like, holy cow, that's fantastic. We have to buy some of that. Well, the next year, everybody was doing the same thing. This guy still blew everybody out of the water. And when they asked him how he did it, he said, I gave the customer the hammer.
Brilliant. I love that.
So maybe, Doug, I'll end with, so I
Please
talked
do.
about the waterproof coating. The first year we raised the money, we now had 12 million bucks in the bank and we're operating and putting the minimum viable product together. We registered to have a booth and a presence at CES conference in Las Vegas, huge consumer electronics conference. I wanted to figure out if there's a way we could get some attention on this. So we set a goal that by the end of that conference in that week, we wanted to see if we could get 1 million page views on our website. That was huge, but that meant we had to get a lot of PR. So for getting that PR, how do we do that? It would mean we would have to become the darling of CES to do that. So we put a tank of water in our booth, and we had tablets, televisions, and smartphones in our tank. The night before the conference opened was media night. At that media night, we had a small tank at a table where the media could come see what it was all about. That night, a producer for Good Morning America came by and said, "That is so cool that about 3 or 4 o'clock in the morning, our time here in Las Vegas, we're going to have Good Morning America broadcasting live. Good Morning America hosts dunk this in the water and do this on Good Morning America."
No pressure.
And we said, "Done, we'll do it." So I had a whole team there at 3 in the morning getting everything set up. We trained the host how to do this, pop this in the tank, and then make a call from outside, put a smartphone in the tank, make a call from outside, and it would show the call light up inside the tank, because then they'd be believers. We had Laura Spencer, and I can't even remember who else we had doing this. They just went nuts saying, "That is so cool. Do you know how many times I dropped my phone?" I think it was Laura Spencer that said, "I dropped it in the toilet twice." And, and it killed the phone. And she said, "This is the most astonishing technology of the entire show." So we took that with our PR guys who were at CES. They took that quote, made up a poster, put it in our booth. Good Morning America had said this, but then they started calling every news outlet everywhere. They have this technology. Do you want an interview? Do you want video? I changed my entire schedule from meeting with potential customers. Staff did all that. I spent my entire show meeting with media. After 2 weeks, we calculated how many page views we had across the planet. 300 million.
Wow.
What a success, except we didn't have the product on the market yet. That was a lesson to me that you can get what you want, but you better be prepared and have an opportunity to capture all of that business that immediately comes to your table. It was an interesting experience.
Very powerful. Thank you so much, Paul. Guys, we're going to see you next week. Donnie, what you mentioned earlier about the article, it's going to be in Charleston again. And then we've got a lot of new things happening and mostly focusing on the roundtable and more intimate, purposeful discussions, building relationships for all of you. This is your event. I look forward to seeing you all next week. And my phone and email are open to you at all times.